All right, in this video, we're going to be talking about equity growth, specifically appreciation in real estate and why it's important in your portfolio to consider the appreciation and the growth of your property. All right, real quick, first things are first. There are 5 ways to make money in real estate. We've got cash flow or passive income. We've got real estate appreciation or equity growth, tax advantages, massive income opportunities, and leverage. We're only going to be talking about 2 of the 5 ways today. And so just imagine how much more money you can make if you were able to incorporate all 5 in your real estate strategy, which if you stick around until the end of the video series and subscribe, you'll be able to see all of these videos that come out. All right. With that being said, there are some properties that are going to produce more cash flow. And the reason for that is maybe they're economically challenged. Right? And there are going to be some properties that grow at a very rapid rate. Maybe they are high desired. Right? For example, Hawaii. Or areas with economic challenges. Let's just say, areas like Ohio, right? Or any other state in the middle of the United States, right? There are plenty of other states. I'm not trying to pick on just one, but you can get really solid real estate deals in Ohio. So if you happen to live in Ohio, make sure you comment down below because you've got better prices on real estate than where I live, which is in Las Vegas. I live in Las Vegas. And here in Las Vegas, we have quite a balance. We're right in between the average. So we have a little bit of cash flow and a little bit of equity growth in our real estate. So I want to show you the benefits of equity growth by showing you 2 different properties and how they grow and produce cash flow over time. Okay, so let's say we purchase a home in Ohio for $100,000, okay? And we're going to erase Hawaii and the word desired. We're going to erase economics, right? And I'm not saying that Ohio grows at this growth rate, but let's just say that the properties are only growing. So our growth is 1%. And our cash flow is 9%. Okay? Another thing to consider right here in Las Vegas, let's say it's balanced, right? Our growth is 5% and our cash flow is 5%. Now it's probably more like 4% and 4% for Las Vegas. And, I don't know what it is. It could be 8% and 2% in Ohio, but we're not going to use some real numbers here. We're just going to use these example numbers just to make the numbers easier to calculate just for your benefit. Okay, so again, we're going to say that we buy a property for $100,000 in Las Vegas. So in Ohio, we're going to produce $9K of cash flow, very easy, and $5K of cash flow in that first year. It's going to go up in value to $101K. Okay, and it's going to start producing, in theory, $9,090 of cash flow. Well, versus over here, we make that over their $5,000 in equity growth. Okay, and our cash flow increases as well. It increases 5,250. So as you can see, 5,000 plus $5,000 of growth is 10,000. 9,000 plus $1,000 of growth is 10,000. They both made the same amount of profit, but as you can see, the cash flow is growing in our Las Vegas property much faster than in our Ohio property. Okay, so with that being said, let's take this and let's expand it by 10 years. All right, now our Ohio property is worth $110,000 and it's producing 10K of cash flow. Our Las Vegas property is now valued at $162,000 and is now producing, $8,000 in cash flow. So as you can see, the cash flow differences are starting to close the gap, but it's still better on cash flow to own the Ohio property. But as you can see, our value is growing very quickly on the Las Vegas property. What does it look after 20 years? Well, after 20 years, we have a value of $122K and cash flow of $11,000. But what about our Las Vegas property, right? So our property value under these growth conditions are now $265,000, and our cash flow is now at $13,000. So as you can see, after 20 years, we are actually making more money from owning the Vegas property as opposed to owning the Ohio property. Okay, so why would somebody buy the Ohio property if it's not going to produce the same way after 20 years? Okay, the reason is because some people are more risk adverse. We covered that in our last video. We showed you that properties with more cash flow are less risky because you essentially make your money back on your investment much faster versus properties that are in high growth markets need to last a really long time in order to take those benefits out, right? So if you were retiring and let's just say, you only have, maybe 10 or 20 years of your lifestyle left to live, well, you might want those benefits right now and you might want to start living comfortably without having to work immediately. So you might purchase more rental properties and more investment properties in this category. But what if you are young? You're not ready to retire yet. You're making a good income with a solid job and you want to better position for yourself for retirement later. Well, it might be a really good time if you are young, purchase a property just like this one. So you are young with high income, and you don't want to pay taxes. Well, then you don't want a lot of income properties, which is just going to add to your current income, and then you're going to have to pay the taxes on that. There's really not a lot of benefit. What we want to get the equity gain. We put in 20 years worth of time, and now let's say we started at 30 years young, and now we are 50 years young. Right? Because we've gone through this 20-year period, right? Now, we want to make less income, right? So, right? We are not as tax adverse. We are now risk adverse. So what do? Well, we sell. Now we have $265K. All right, what's $265K and how many properties could we purchase? Well, we can buy 2 properties in an area that's more affordable than our area, right? And so we buy 2 properties and we have $21,000 left over. Maybe we go upgrade our car in retirement. Now we're driving a nice fancy car in retirement. And so what does our cash flow look like? Well, we buy 2 of these, which turns into 2 times 11K, so $22,000 a year in passive income, right? From simply purchasing one home, paying off the mortgage, letting the equity do the work, and then going into cash flow rich markets that are more affordable to live in our retirement years so we don't have to work so hard. So this is exactly how you can use equity in your strategy. Now, in order to appropriately calculate equity and equity growth, we're going to have a calculator up on the screen for a future video. So we're not going to show that in this video here. Make sure you give us a like, a subscribe, and some comments down below how we can make the videos better and to participate in future videos. Thank you for watching. Have a great day.